Hey, James. So, you look at these numbers, right? 4.2, that's on the screen. And then you hear that like the third person at your office this quarter just had their role totally like restructured. Both are true, but neither's really being measured by the same thing, is it?
No, absolutely not, Amara. It's quite stark. You see the headlines, Congress, executive orders, big safety summits, they're everywhere. But then you look at the actual order book, what's being priced, and it's telling a completely different story. And the gap between those two prices, it's the widest it's been all year. It's wild.
Right. So I'm just sitting here thinking, what on earth is actually being decided this week, through a channel that literally nobody is watching? Like, what's going on behind the curtains?
Oh, that's the absolute core of it. So the Kalshi contract on Fed AI risk guidance by year end, it's sitting at 62 cents. But the whole institutional narrative, Wall Street Journal, Financial Times, all the talking heads, they're pricing that exact same outcome at 20 cents. And they're all like explaining it so confidently, saying AI regulation is just paralyzed by election cycles. But the order book is literally screaming that's not where the rule is being written. It's a huge difference, really.
Okay, so a 62-cent contract versus a 20-cent narrative. That's 42 points, James. That's not just a little rounding error, That's capital looking at one channel and narrative looking at a completely different one. And these channels, they're forking like every quarter. What's causing such a massive divergence?
Well, the narrative, Amara, it's watching Congress, right? Because the whole press apparatus is just calibrated to the legislative process. It's hearings, it's votes, marked up bills, conference committees. Those things they photograph so well. They produce these quotable moments. They generate the rhythm that the political coverage cycle is built around. It's very visible.
But the order book isn't watching that, is it?
No, the order book is watching a totally different rhythm. It's the Fed Financial Stability Reports. It's the SEC Investor Advisory Committee Minutes, the OCC Model Risk Bulletins, Treasury Office of Financial Research Working Papers, and all those requests for comment that close on Tuesdays that nobody ever covers. The agencies whose mandate touches systemic stability, they don't need legislative permission to issue guidance. And guidance, once it's issued, it becomes precedent. And precedent, once it's cited in an enforcement action, it becomes enforceable. That happens between hearings, in that gap the cameras don't point at. It's absolutely critical.
This really aligns with what the day's keyword field is showing. Like when it surfaces stone, the cut block, the squared ashlar, alongside one, the singular foundation. It's like the structural mandate of the moment is consolidation, right? Authority that's been distributed is now being compressed into systems that just act without asking. The agencies are just, squaring that block.
Exactly. And we see it directly inside enterprise compliance. The companies I work with, they're not waiting for an executive order, not at all. They're already documenting their AI deployment posture against a regulatory architecture that hasn't even been written yet. Why? Because the agencies have been signaling. Internal audit functions for model decisions, provenance trails on training data, tiered approval for autonomous actions, paper trail hedging. It's all happening already.
Paper trail hedging. That's the operational tell, isn't it? When a sector starts documenting its compliance posture before the rule even exists, that sector knows the rule is coming through a channel the public isn't tracking. The companies that build those records first, they're going to be on the right side of the floor when it pours. The ones that don't, they'll be on the wrong side. It's a huge strategic advantage.
It absolutely is. And there's another contract worth looking at. AI Reg 26, White House Executive Order status. It's at 42 cents. The narrative's pricing that one at 60. So the order book is simultaneously saying the agencies will move at 62 and the executive order won't at 42. The narrative is inverting both. That's not noise, Amara. That's the order book identifying which channel is alive and which is just decorative.
Now, let's drop one floor down. The unemployment rate is still sitting at 4.2. The Kalshi contract on unemployment crossing 6 is at 12 cents. Narrative agrees at 15. There's no tradable divergence on that headline number, But the headline number, it's not really measuring what people think it's measuring, is it?
No, it's not. The BLS instrument was just calibrated for an industrial economy, where the binary was like employed or not employed. But the economy underneath that metric, it's shifting from a population of decision makers to a population of decision supervisors and prompt operators. The rate stays at 4.2, but the ratio of decision bearing to decision executing roles changes by quarter. No statistic publishes that ratio. It's a huge blind spot.
Wow, that's what you're seeing in enterprise hiring, right?
Absolutely. The roles aren't being eliminated, they're just being restructured around AI tooling. The new headcount slot is never opened. The existing person stays employed, but the ladder above them is shorter, and the work below them is increasingly delegated to systems they don't own. JOLTS, white-collar, and information openings, they're the leading indicator. Median income trajectory for credentialed workers under 35 is the second one. The wage curve is already showing what the unemployment print won't, you know? It's a quiet revolution.
This is the failure mode that really, really matters. When a measurement instrument no longer captures the phenomenon it was designed to capture, the system just passes through a phase transition without that transition even registering. The metric appears stable, but the economy under that metric, it's being totally re-stratified. And the political feedback loop that would normally fire, unemployment rises, electorate responds, policy adjusts, it just doesn't fire because the input doesn't move. It's truly unsettling.
And the third domain, Amara, is the one with no instrument at all: cognitive strain, AI subscription churn, whatever you want to call the user experience cost of routing decisions through layers you can't audit. Kalshi has no contract, there's no proxy, no counterparty pricing that externality. The strain just compounds because nothing disciplines it. It's a truly unaddressed problem.
This is the void the day's mandate is naming directly, isn't it? Conscience, that inner tribunal where motive is weighed. When external legal constraint is too slow and external market constraint is just absent, the only remaining constraint is internal. The day's keyword field isn't metaphor here, it's operational instruction. It's naming the layer where audit has to happen because no instrument operates there.
I really want to push on that, because no instrument exists can mean two things. It could mean the strain isn't structurally significant. Users adapt, the way previous cohorts adapted to email or push notifications, infinite scroll. Or it could mean the strain is real and unpriced, because the proxies haven't been built yet. The way to discriminate is enterprise AI tool retention and cohort attrition over 6 and 12 months. If retention holds, the strain is being absorbed. If it degrades, the void is real. But right now, the public data is insufficient to distinguish, which is itself the problem the void describes. The instrument that would tell you whether the strain matters is the same instrument that doesn't exist.
So, if I'm a listener, I'm operating without an external signal in the domain where this migration is fastest. That's the individual decision environment. I open a model, I delegate a task, and somewhere in that motion, a choice gets made about what kind of work I'm still doing. The choice doesn't announce itself, James. There's no Chiron for it, There's no Kalshi contract.
The mandate, Amara, is to audit the routing yourself. Identify the specific points in your day where decision authority is being routed to a model rather than weighed by you. Reclaim those points, or just accept their migration. But do not pretend the migration is not happening, because the legislative narrative says it cannot. The legislative narrative is watching the wrong channel. It really is.
Now pull all the way back. The same pattern is operating across these three domains in this single day. AI regulation migrating to administrative channels, while narrative watches legislative. Labor recomposition occurring below the metric, while narrative watches the headline rate. Cognitive strain compounding without an instrument, while narrative watches subscription growth. 3 domains, 1 mechanism. Authority migrates faster than the apparatus tracking it.
That's the harder return. If JOLTS keeps degrading while BLS holds steady through the second and third quarter, that political feedback loop that would normally fire, it just doesn't. The rebasing entrenches. If Fed AI Reg resolves above 80 by year-end because agency guidance arrives, the regulatory floor pours under the enterprises that already documented their compliance posture and under the enterprises that didn't, bifurcation by quarter. And if a high-visibility AI failure event hits within 90 days, like agentic deployment failure with attributable damages, large-scale hallucination reaching litigation, an autonomous system incident with measurable harm, the timeline compresses from year-end to inside a quarter, and the architecture written under emergency conditions will be more restrictive and less precise than what's being drafted now in the gap between hearings. The window where you can position deliberately is open right now. It's becoming a window where you respond reactively. After the failure event, the window closes entirely.
So, here's what to watch for. Not the executive order, not the safety summit. Watch the next Fed Financial Stability Report, the next SEC Investor Advisory Committee minutes, the next OCC bulletin. Watch for the phrase algorithmic systemic risk or any close cognate to enter an agency document. That phrase in that document is the threshold crossing event. Until that phrase prints, the floor hasn't poured.
And the day after it prints, the floor has been pouring for months, and you were just watching the wrong channel. The contract is at 62 cents because the order book has already done the work, Amara. The narrative will catch up 4 to 6 months late. The question between now and then is whether the migration in your own decision environment, those points where you have already routed authority to systems you cannot inspect, gets audited by you or gets settled by default. It's a very personal decision.
The channel they are not watching is already open. The squared stone is already cutting. What you do this week is what gets built into the wall. It's really that simple and that profound. Thank you so much for tuning in, dear listener. Before we delve deeper, if you're finding these insights as intriguing as we are, please take a moment to like, comment, share, or subscribe to help us grow this vital network. Your engagement truly makes a difference.
And that engagement, Tamara, is itself an audit, isn't it? It reflects a conscious choice. Much like the personal audit we've been discussing, the deliberate act of discerning where your own decision authority is being rerouted. It's not just about watching the right channels externally, but internally too.
Precisely, because the most profound migrations don't announce themselves with fanfare. They whisper into your daily routine, subtly shifting the ground beneath your feet. It's the moment you trust a system to generate a response, rather than crafting it yourself, or allow an algorithm to curate your next task, rather than choosing it.
Those moments are critical. Each one is a micro-decision point. The aggregate of those micro-decisions shapes your operational posture, your career trajectory, and ultimately your agency in this evolving landscape. The cost of not auditing them is paid in diminished autonomy, often without you even realizing it until it's too late. So actively